Up next, we're going to talk about treasuries on token rails. So we live in a 24/7 global economy, yet corporate treasuries will still operate on antiquated batch processing systems. Billions in capital remains trapped in slow, opaque, cross-border payments and inefficient settlement cycles. So this panel is focused on unlocking that value. We are entering an era of treasury on token rails. This session explores how tokenized fiat, digital currencies, and tokenized assets are transforming corporate finance. Imagine achieving true, instantaneous, intraday liquidity, settling complex foreign exchange transactions automatically, and collateralizing assets in real time. This isn't theoretical, this is being built right now. And our experts will discuss the technical blueprints and regulatory pathways for this transformation. So get ready to learn how blockchain is turning the sluggish world of corporate finance into an instant, programmable, and radical, more efficient operation. This panel is moderated by Louis Schaubert of AllUnity, but he also wants to give a reality check. Is this actually happening? What's the timeline for that process?
Just waiting for one more of us. All right, so welcome to our panel. It's about the treasury on token rails. So the question more or less if we can really move the treasury, so including stablecoins, etc., on chain. And I have here a really interesting round from different perspectives of the market. And maybe everybody can introduce yourself, where you are, what you're doing, and maybe also your first take on if we can move really treasury on token rails, and how you see it.
Should I start?
Yeah, sure.
I'm Nicholas. I'm working for Bank Frick. I'm running their blockchain banking department, which is essentially the sales department. My first take. It's an interesting topic. Everybody's talking about it. Everybody's developing around it. But I have to say, from a bank's perspective, most of the players are not ready yet. I think we're making good progress, but I think it will take time, and I think that's what people are missing most of the time.
Hi everyone, I'm Cristiano. Unlike what you see here, I don't work for ESMA, I work for Moody's Ratings, the rating agency. It will take time and it will happen heterogeneously across the globe because we are seeing a lot of regulatory and market practice that are diverging, but at the same time, it's probably the only way we have for digital cash and in general for on-chain finance to really expand.
David Regelnik, I'm the CEO and co-founder of RuleMatch. We are a marketplace for banks and securities firms in digital assets, crypto, and in the future also tokenized securities. In my view, I think the topic is really very timely. I think we should really talk about tokenized money market funds, really being one of the first use cases where we really start to see traction in this regard. So I see treasuries in this context. And I would say when we look at the already quite staggering volumes that have started to be deployed there, I think this gives us a bit of a glimpse of what we will see. And in my view, 26 will be a year of breakthrough in this area.
Yes, I totally agree. So maybe the first question is, if we go maybe one step back. So I mean, yes, we have stable coins, we have tokenized assets, etc. But I think the main question is all about infrastructure. And I see, yes, there are Coinbase and the big crypto players, they are outside, they have already the infrastructure ready that you can move everything on chain. But what is your opinion about, is, I would say, the old world also ready already that we can move everything on chain, especially also money? So what's your take?
I think we're not ready. Speaking for not every bank, but for quite a lot of banks. I think if we go one step back before infrastructure, I think we've done a lot of great work in the past. We have regulation in place, we have tech in place. Now, I think the players which are responsible to move the next, to the next step or start the next phase will be the institutional players. And I think as soon as the big banks or the big asset management companies start to really look into that, what they're already doing, but if they come up with a solution, I think then we're at that point where it really starts. And I think we're very close to that, but I think most of the players are not ready yet to start from tomorrow.
Yeah. How do you see it, David? You built infrastructure to connect both worlds.
Of course, and I mean, of course, also I see that. I think our colleague has been also modest. I think Bank Frick, for example, has been one of these players who is quite active in the field, and I think that's what we see in general, right? You have typically those first movers, those banks and securities firms that really deal in crypto, and I think we have always been of the opinion at RuleMatch that those who really deal in crypto will be the first really dealing also in tokenized securities to some extent, because you need the ability to have your custody, to be able to work with blockchain in a regulated fashion, that you can really consider using this also for tokenized securities. So I would say when it comes to readiness, what is certainly missing, I think, are clearly also certain regulated infrastructures, particularly when it comes to a secondary market, which of course when we talk securities, then of course it is a different bar, right? You need the respective licenses. I think this needs to be around so that really these products can be sold and bought in an effective and efficient way.
Yeah, totally agree with both. I will just add that in order to understand the readiness, you have to count how many processes are actually off-chain. Let's just give an example. Stablecoins, underlying assets, off-chain. On and off-ramp providers, off-chain. Ledger that provides legal validity, mostly off-chain. So these three elements alone, should be enough to convey the message that, on-chain finance is not there yet, and it doesn't necessarily mean it's a bad thing in the sense that regulators and market participants take time to understand what is the best and most reliable solution. And as all things, it takes time, especially when it comes to combining multiple regulations. So I will say that's the kind of the litmus test that sometimes we do to understand to what extent a process is really fully on-chain and to what extent the frictions that we see today prevent, efficiencies and savings to fully unlock.
Yeah, and where do you see more or less, when we just go now really on the technical side of things, where do you see really the bottlenecks? Because, for example, what I often see is that everybody's talking about APIs, that you can easily connect wallets to the core banking system, etc. Do you see that this is really that easy, that you can just plug and play everything, or is it more the opposite, I would say?
We would love to see that, but in reality, it's unfortunately not the fact. And I think Cristiano brings it up pretty exact. There's a lot of things which are still happening outside or off-chain, as you called it. It's not as easy as you say, I want to have this product, I tokenize it, I use it. It's like there's so many different things which are needed to make it happen. And just, if you look at it from a banking perspective, there's so much regulation coming in, there's so much security processes you have to be aligned. And then if everything works and if everything works out, then it's about connectivity. And then we can talk about if it works with API, how easy can it be done? But I think there's still a lot of work to be done. And we as a bank, we're always trying to be at the forefront with this, and we tried a lot of things, but we can say from firsthand how difficult it is to implement things like that and make it work. Because sometimes it sounds so easy and people think, oh, why are they not doing it? Because it's not as easy as it sometimes sounds.
Maybe David, you are one of the connectors.
I think, as I said before, I think the bottlenecks probably are much more in the regulatory space than let's say in a technical, even though, yes, of course, you need to build up these capabilities, so you need to have your own custody and so forth as a regulated player. But I think we should really not underestimate, particularly now that we talk about here tokenized securities, that along the whole value chain, each party touching a security needs to be licensed, right? That's the massive difference to Bitcoin or Ether, right? Which, of course, to this day have a different status. And even though we have, for example, in Europe now with MiCA, to some extent also the need for licenses, This is still not on the same level as we have it with securities. So I think this is we have to be aware about that. At the same time, what I see clearly, I would say, when you said bottlenecks, I think once this is overcome, once we have these let's say, stable coins, these regulated stable coins that we have now seen also recently, for example, in the MiCA space, or when we have marketplaces that have obtained the necessary licenses to trade tokenized securities, I think this will unlock these markets, which I think many are waiting for. And I think we will be surprised, most likely, how it will unfold. Because other than crypto, let's be very honest, despite the fact that we might love crypto here, most likely in this audience, but let's be clear, I mean, it's still a polarizing topic to some extent. I think this will be different, I would say, with tokenized securities, because they are basically on a philosophical, political level, there's much less resistance. It's more the make it happen, get over the finish line with these licenses and regulations.
Okay, yeah, totally agree. And as everybody of you guys mentioned, regulation. So just maybe, I mean, many panels are here around MiCA and so on, but what is your take especially on this one? I mean, we have MiCA, we have now the Genius Act in the US, etc. And what is your opinion? Is it more or less good that we have now MiCA, Genius Act, and all the local stablecoin regimes? Do you think this brings really the buy-in of the TradFi world, that they say now, look, we want to move on blockchain rails, or do you say like more or less it's also an innovation stopper because you have different regulations, so you have different requirements, etc.?
Let's say it this way. I think regulation is key. I think that's the most important of everything. Without, we cannot do anything. And I think it's the first step which leads to bigger players stepping in. And because we need regulatory clarity. We have, as you said, we have Genius Act, we have MiCA here in Europe. And I think it's a great foundation to start building on it. If it's the 100% perfect solution, who knows? I cannot judge that, but I think regulation is key. We need to build on top of that, and I think with that, it enables us to build. So it's, from my point of view, the most important part.
Cristiano?
Yeah, I think it's, I mean, competition, quote-unquote, competition among regulators is good, not because, I mean, when I say competition among regulators, people sometimes expect regulators to go to a race towards allowing companies to do everything, which is not the case. Competition is a race to provide clarity to market participants, and then every regulator will decide their own level of risk appetite and risk aversion. And in this way, having US, Europe, and Asia actually competing in the sense that providing more clarity for market participants is actually good. We don't have to expect convergence today, neither tomorrow. It will take a long time, and in some cases it might never happen because there are political, economic, and strategic objectives that are potentially different. You see US and the stance on stable coins and the stance on CBDCs, and then you see Europe, which has actually a, not opposite, but a quite different stance. And regulation is also a byproduct of political and strategic decisions on how to implement and how to modernize finance. And then, I mean, regulation is an iteration that is based on what is happening in the market. I will just give you an example because it's connected to infrastructure. When we talk to companies in the market and we try to identify the weakest link in a value chain to say, hey, this could go wrong, you should pay attention to that and you should really clarify what you are going to do in case things go wrong. The usual comment, especially from startups and new challengers, is, come on, it's going to be fine. It has worked for 5 years. It's going to work the same, in the foreseeable future. A couple of weeks ago, you guys have seen that a stable coin has minted $300 trillion on chain for like 22 minutes. So these things, when they go wrong, they could go really wrong. And in that case, it was pretty much a harmless mistake, but that's not going to be the case in the future. And that's why we always look at the weakest link in the worst possible scenario, because 99.9% of the time it's not going to happen, but we have to assess the risk of the tail of the distribution, not the average. And that's why when it comes to regulation, we understand why some regulators are potentially more restrictive and more conservative than others. And it's not because of the sake of it. It's because, things could go wrong in a variety of ways, especially because this is a new technology, this is a new ecosystem, and we still are not best positioned to understand how all the things piled together could potentially go wrong.
And I don't know, it's also an open question. Do you see more that this is already like that the banks and so on, so the TradFi world really understood, especially these regulations, because for especially also MiCA and so on, it's really complicated. Then you have the Genius Act, which is more or less a little bit different than MiCA. So do you think also that there's also some education missing, or is everybody already on track to say, okay, now the regulation is clear, in this country we have to do it in this way, in Europe we do it this way, and in the end we go in the same direction?
Yeah, for sure. I think, absolutely, I think this is, the more regulation there is here, the more I think it really requires a certain sophistication on the level of players. And of course, the incumbents, the existing banks and companies, players really know how to handle this. So I think they are in the best position to also take advantage. At the same time, in the end, of course, also new players can learn the trick, right? As we have seen, usually there is a higher risk appetite, nevertheless, despite the regulation, and also a certain willingness to really to be innovative, as we have seen recently. I would say, overall, I mean, just to summarize what you said before, for sure, I mean, this regulation, regardless European, US, and so forth, it's kickstarting that market, no doubt. As a regulated player, you wouldn't want to touch something that is somewhat unclear, and now with these rules, it is the way is open, and I think it just needs now to unfold, and we will see this. I think we will stand indeed, literally in front of an explosion.
Yeah.
Yeah, I think one important thing is, before I said regulation is key, which is true, but I think it's a very small path between having a proper regulation, having an over-regulation. Because if it's so complex that all the legal compliance and risk departments are growing like crazy, I mean, that's the question if it's then already over-regulated, because you need so many people to understand how things are done or how they work. I think it's a small path, and we have to be very careful. Like, we cannot really change it, but I think it's something which would happen sometimes, that people bring up ideas and rules without understanding how things work, actually. So it's a threat, if you ask me.
Yeah, I just want to add one thing. It's not only a matter of risk and regulation, it's also a matter of incentive. So right now we are seeing, even in Europe, which is kind of conservative, we are seeing, for instance, stablecoin issuers becoming, creative and trying to find use cases even where, regulation doesn't necessarily explain how to do that. For instance, just an example, a couple of banks have issued stablecoins that are now traded in the DeFi space, and you can potentially earn a yield on such stablecoins, even though, MiCA formally prohibits any kind of yield paid out of the issuer. So the balance is not only driven by what regulators and what, compliance or legal decide, but it's also driven by what is happening in the market in terms of how to find a way to make supply and demand meet somewhere, which is something that most people take for granted because it looks like everything happening on chain is automatically profitable. It's not. It's actually very rare for any business on chain right now to be profitable, especially when it doesn't involve cryptocurrencies. So finding the right incentive, finding the right balance is also what will drive progress and innovation. And of course, regulators will have to catch up.
Yeah, this directly brings me to the next question. So what is your opinion on, is it really like when the money moves now on chain, you have stable coins, you have tokenized deposits, which is a completely other topic in this direction. Do you think this brings directly the efficiency, or is it more about, okay, we now have to build first the infrastructure, so bringing assets on chain, then we have to bring the money, the cash leg on chain, and then we now have to see if it's even working? Or do you, for example, with Rule Match already have there's something approved that it's already like faster, cheaper, more efficient?
Yeah, no doubt. I mean, I think we don't have to really wait or look for the use case. Let's be clear, when we think of our operations, of course, there is daily settlement. In our case, we have trading with a T+1 settlement on a net basis, which is highly efficient, of course, for these banks and securities firms trading on rule match. But still, of course, we do have still a cash lag, and this is facilitated by banks, right? And also, since it is done in dollars, it also involves correspondent banks and so forth. Being able to work with stable coins in this regard, of course, really will unlock weekends, will unlock basically 24/7 also bank holidays or currency holidays that are a reality. So stable coins certainly will make it much more efficient. And I mean, there's the point, fully aware that on the decentralized world in DeFi, this is already a reality. But again, this is still a very small niche. Don't underestimate how large this world really is. I mean, we do know the trillions that are traded in capital markets, and so moving them towards stablecoins will for sure happen inevitably. And I would also say, maybe to the topic of our panel when it comes to really treasuries or on rails, I think the distinction between, let's say, the stablecoin without a yield on the one hand side, and then on the other hand side, potentially yield-bearing instruments such as tokenized money market funds, or potentially also maybe bank deposit tokens, potentially, I think will complement each other very nicely, right? So that you could, depending on the use case, really decide, okay, I want the stability of a stablecoin which is 100% or even more backed versus a yield-bearing product. I think we will see a lot of change also traded between these products. They will rival each other, but they will effectively also complement and grow together, in our view.
Mm-hmm. Yeah. I mean, from the bank side, I mean, you're in both worlds. So what is your take on this, especially as you are probably one of the key players for the on and off ramp from the fiat side of things onto the tokenized world?
I mean, I agree with what David says. I think it comes hand in hand. If you reinvent capital markets nowadays, it would probably be 24/7. But it's only possible like if money also moves 24/7. And nowadays, most of us know if you go to a bank, you can do payments. They're executed between 8 and 5 during the weekdays. What's the reason for that? I mean, like, it comes from the past, but in the future, there's not necessarily a need for that. But in order to make things faster, to make it more efficient, I mean, you have to bring it on chain. And yes, I cannot speak what happens within the bank, but it's not as easy as it sounds like to make this accessible. And I mean, at one point, we'll definitely see that's my opinion, that people still use banks and they still execute payments over banks, but probably going peer-to-peer. Then with stablecoins, they execute a payment, settled as a stablecoin, there's no correspondent banking between, and everybody wins. It's cheaper, it's faster, it's more efficient. But I don't really see the reason that there shouldn't be a bank inside. And I think if the payment side is automated, if fast, it's efficient, I think then it's about also capital market. But I think they come hand in hand, and I think one is needed for the other. And so it's don't want to call it as a chicken and egg problem, but I think we're developing two things at the same time, which we have to find or bring together. And I mean, there are many more use cases for this, but yeah. So
yeah, and just to add to this, I totally agree on David's point on convergence and coexistence, because at the end of the day, there's not going to be a single digital instrument to rule them all. It will be a coexistence, and sometimes people get confused about the trade-offs that they have in accepting one against the other. And for instance, a great example is stablecoins versus money market funds. People think that tokenized money market funds are just a version of stablecoins with yield on top, and they say, oh wow, it's amazing, why would I even need stablecoins? But if you read the fine print, tokenized money market funds don't have a promise to give you the dollar back when you invest, whereas stablecoin have. And again, this is a small detail that won't make a difference 99.9% of the time, but that's where trade-offs lie. You need to read the fine print, you need to understand exactly where you are investing or where you're exposing to, because these products are not the same, even though they might look similar. And that's why, as David said, stablecoins, tokenized deposit, CBDCs, or whatever other solution central banks come up with, they all have different use cases that will coexist together, and the way they will coexist will determine the efficiency of each.
Yeah, totally agree. So as we're more or less coming to the end of the panel, I mean, one main question is, I mean, we have the infrastructure, step by step, the old world is building it, the new world is more or less ready. We have already first assets that are tokenized. We have there the regulation. We have now different forms of money already on chain. But what is your opinion, direction? Who should move? Who should more or less lead this innovation path? Is it the new players on the block, as for example us, stablecoin issuers? Should we go out and say like, look, you need to switch on stablecoins, or is it somebody else in the market? So where do you see who should take in which step, I would say, the lead to bring more or less treasuries on chain?
I would say to start with that question, I would say the issuers have done their job, so to speak. I think that is, for example, Euro really have been able to really provide such a regulated stablecoin is really the first step. But I have no doubt that the actual adoption is the job of the others, and they will come, right? Because they will basically really leverage the benefits they see. And maybe it's one element I would like to also point towards, which maybe is rarely discussed, and maybe worth to say here. The whole topic of collateral, of course, is often discussed, right? Using these type of products as part of collateral, particularly if they're also yield-bearing. But there's even something else. We shouldn't forget there's a large part of the financial industry in the meantime, also in parabanking sector, basically maintaining accounts for people, holding value for people, maintaining accounts in various facets. And here, potentially, also for banks even, potentially to basically offload that to some extent to an off-balance sheet product. So rather, instead of really maintaining accounts for clients, rather basically having in custody tokenized value is quite attractive, particularly given the capital requirements that we face. I think that's another element which I think we'll see going forward.
What's your take?
I think the TradFi institutions need to move because you said it. You made some noise, and the new guys made some noise. They proved that they are relevant. There is capital behind it, and I think now it's about the old world to start working on it, just to make sure that they are ready, because otherwise the new players will replace the old players. That's my take.
It's more or less a good ending, but what's your take?
Yeah, no, I totally agree. I mean, challengers are faster and leaner than incumbents, and they can show that something new can be done in a certain way. Their incumbents say, hey, this is actually good. I want to do that too, but at the same time, I cannot do it because, I don't know, I'm just saying, regulators prevent me from doing X, Y, Z. And then it's on the regulator's court to decide to what extent to level the playing field or to introduce new regulation for challengers, to relax regulation for incumbents. So it's a process that involves all the players in the value chain. It cannot be driven by only one. And that's how it has always been, and digital finance is not an exception. So, I mean, it's Europe specifically, we already know that we are facing a huge competition from US, and even the future of euro is linked to the extent to which digital finance can support the acceptance of euro, not only at the domestic level, but also at the cross-border level, because that's a much tougher game to play.
Cool, yeah. So yeah, maybe to close the round, and thank you for listening. When do you think we see really the big moves with that Treasury is really moving on chain? Is it already next year, or do you think it takes more time?
I hope next year. I think it takes a little bit more, but I hope for next year.
I do see breakthroughs in 26. I mean, also don't forget about the volumes we see already from let's say, Franklin Templeton and BlackRock and the others in this space, and I think it will continue on a massive pace.
Yeah, probably in the US it will be 1 or 2 years, Europe a little more than that. But at the same time, it's not something that is in a distant future. It's something that we could potentially see and maybe touch even now.
All right, cool. So thank you, and thank you for your time, and looking forward to the next panel.
Thank you.
Good.